Hello, and welcome to Apella Capital's semi-annual market update. My name is Jason Gentile, Senior Financial Advisor with Symmetry Partners and Apella Capital. Today's topic was originally designed to be a recap of what happened in 2015 across equity and fixed income markets, as we normally do. But recent volatility in the stock market has prompted me to kind of change direction a little bit here. We're going to spend some time discussing 2015, but I also want to focus on what's happened so far in 2016, as it's been a pretty dramatic turn of events. Joining me today is Phil McDonald, Associate Director of Research with Symmetry Partners. So thanks for taking some time to answer some of our questions today.
Thanks for having me.
So, I mean, let's start where I said and kind of do a review of last year to help set the table for what's maybe going on today. So kind of take us through how global equity markets performed and acted last year.
Sure. At the global level, I think it makes sense to start talking about the MSCI All-Country World Index. That was down slightly, around 2%. And that's relevant because our equity portfolios are globally diversified. But we like to think in a little more specific terms, major geographies first and foremost. So considering the US market, that was up slightly at positive 2% if you consider indices like the S&P 500 or the MSCI USA. The second region we look at, developed international, was down ever so slightly, just negative, just below zero. And the relevant index there would be the MSCI EFA index. And thirdly, and most importantly, the emerging markets region was down significantly. So the MSCI Emerging Markets Index was down about 15%. One thing to keep in mind is that these returns numbers are in US dollar terms. And we also had a relatively unprecedented quick move in the US dollar appreciating last year. So the impact that had was it made the actual foreign currency returns look worse. So in reality, in the local currency terms, the international developed market was positive. It was about 5% up for the year, and emerging was less negative. Furthermore, I think it makes sense to dig a little bit deeper. As you know, we're multi-factor investors, and it makes sense to kind of consider which factors contributed and detracted from performance last year.
Okay.
Momentum was a strong contributor. Value was a strong detractor. Small cap factor was slightly negative, and the profitability factor and the equity market premium were both small contributors. And those numbers are actually through the end of November. So, going back to earlier in 2015, we actually made the move to strategically shift to capture more of these factors kind of at the same level at the same time. And that diversification likely helped us in 2015, allowing for, the momentum and profitability to contribute while the value was a detractor.
So it's really, as I look back at 2015, as you mentioned, emerging markets were, I guess, pretty weak in general terms, but they've actually been struggling for a couple of years now, post-2008. Why is it important that we maintain an allocation to markets like that? It's a pretty common question. Well, if something's done so poorly, why do you continue to hold it?
Right. Well, that really gets to the core of diversification. If you're well diversified, you're always going to hold something that you're disappointed with.
Right.
I guess more specifically, emerging markets is still a reasonably large component of a global index. So if you consider the MSCI All-Country World Index, we're talking about 9% or so allocated to emerging markets. So it's large enough to not be ignored. And probably most importantly, equity markets are risky, and emerging tend to be more volatile than developed markets or the U.S. And it's really hard to predict when that inflection point is going to come and when underperformance becomes outperformance.
Right.
So remaining fully invested in well thought out strategic allocations makes sense, and that's really the reason why we maintain our emerging markets exposure.
That makes sense. to kind of compound matters, last year we saw our first uptick in interest rates.
Right.
What are your thoughts on how bond markets and equity markets, I guess, reacted to the first rise in interest rates in quite a long time?
Right. You're absolutely correct. So the main interest rate of focus here would be the Fed funds rate. It's the short-term monetary policy rate that the FOMC will set in their regular meetings. And since 2008, this has essentially been zero.
Right.
In December, so just about a month ago, we got our first uptick in that rate, and it went up 25 basis points. I'd like to maybe set the perspective here a bit. First of all, it's a relatively small increase, so
Yes.
it's 0.25%. Secondly, I think it was very well anticipated, not only by news media and pundits who have been predicting this pretty much for years and years, but the FOMC itself had been giving some pretty clear guidance about their priorities with regard to how strong the economy is and when and by how much they would likely increase this rate. And third, most relevant to our portfolios, this is much more specifically related to the U.S. market, U.S. fixed income, and like the equity portion of our diversified portfolios, our fixed income allocations are globally diversified. So it will likely not have the direct same magnitude impact on non-U.S. bond markets. That said, in December, the Barclays U.S. aggregate index was slightly negative. You would expect, just because the mechanism at work here is price and yield on a fixed income security are inversely related. So as that market interest rate increases, you would expect downward pressure on the price. And it's something to keep in mind. The Fed is going to keep monitoring the strength of the economy. They're a very data-driven organization, so they'll keep track of unemployment and inflation and economic growth. And more likely than not, there will be more increases, hopefully, likely 25 basis points at a time.
Right.
So as they make, hopefully, the right decision based on their data, and they act reasonably and slowly, you would expect the impact to be less, not a bubble bursting type of impact on fixed income. And taking a step back and zooming out just for a minute, all of 2015, looking at the entire year, both the Barclays U.S. aggregate index and Barclays global ex-US dollar index were up slightly. So, big picture, we think fixed income is still very relevant for many investors. For any investors who can't take full equity risk,
Right.
it is still a relevant part of the portfolio, and will likely, even in a rising interest rate environment, it will likely still not be nearly as risky as equities in terms of volatility or drawdown.
Right. I think at the end of the day, we're using that as a hedge against the risky side of the portfolio, where you get
Right.
more bang for your buck, being the stock side.
Right.
So let's kind of pivot and look towards what's going on right now, current events. A big issue in the news, we see it all the time, is the continuing drop of oil prices down to
Right.
roughly around $28 a barrel. We never thought we'd see that again. It seems like it would be a good thing for U.S. consumers, right? Cheaper oil prices, cheaper gas prices, more money in my pocket.
Right.
Why has that not been reflected in the way equity markets and maybe people's spending patterns
Right.
look right now?
Yeah, I think it's a complicated issue, but I think I would start by saying there's really no proven direct causal kind of relationship between oil and equity markets. And you can see that. I looked at two indices that will convey this pretty clearly. The S&P 500 index, so the U.S. large cap type of companies, and the S&P GSCI crude oil index. And over any meaningful time period, you essentially see pretty close to a zero correlation. That said, I think you correctly identify, recently both have been down at the same time. I would encourage investors not to jump to too strong of a conclusion from that short-term kind of pattern of coincidence, and we don't really think it would lead to any direct action in the portfolio. That said, the energy sector is roughly 6% of the portfolio, and that's about in line with the MSCI All Country World Index, so the global index that we look to as a benchmark. So, to whatever extent oil continues to slide and has an impact on the corporate strength and earnings of oil companies, you might see additional weakness in that sector. Again, it's tough to predict.
Right.
And going back to one of your points earlier, I would agree it's probably a big benefit to consumers, likely to a relatively small portion of their budget.
Mm-hmm.
And since Americans really don't save much, I would expect eventually that money to be spent. So it is a nice rebate to consumers and really any consumers of energy at this point. But bottom line, I think what's at work here is that oil is a well-traded commodity, and it has an active market. And in free markets, supply and demand really set the price, right? So I saw some statistics recently that over the last few years, demand hasn't really changed too much. Global demand for crude oil hasn't really changed too much. What's really changed is supply has gone up.
Right.
So the U.S. producing oil from different shale projects and OPEC, more specifically Saudi Arabia, voted not to reduce production quotas. So what we're dealing with now is a lot of supply and really demand not increasing to meet that supply. And what you get is a lower price.
Right. Basic economics.
Right, absolutely.
There, I guess. So I think one of the things we hear all the time, which probably ties right into that supply and demand story, which maybe it's overblown from the demand side, China, right?
Mm-hmm.
China in its ever slowing growth, which we can't seem to wrap our heads around.
Right.
What do we see from China? What's actually going on there from our perspective?
Right. I think, China is a relevant country. It's absolutely a relevant topic to cover. It's a large economy, although it's a somewhat smaller equity market than the size of the economy would kind of correlate with, and that's really just because public markets haven't provided the financing to Chinese companies. Sure. They're, privately owned or government owned. China has experienced very impressive growth, really by becoming the world's factory. So there's a lot of production in China, and they export goods and services back to countries that invested in productive capacity in China. So China is a significant portion of emerging markets. Mm-hmm. As I referred to earlier, emerging markets are roughly 9% of the All Country World Index. And China is roughly a quarter of that. So in our portfolios, you will see about the 7 to 10% exposure to emerging markets, depending on which equity portfolio we're talking about. And China somewhere between 2.5% and 3.5% of that. I think the couple of stories with China that I think need a bit more time to play out are the question of the level of their stock market, which shot up very quickly in 2015. There could have been a lot of speculation and borrowed money in that market. So we're seeing the Chinese market have several weeks now of pretty strongly negative performance. And what might be at work there is kind of just coming back to earth. It's again, hard to predict. And secondly, it's pretty well agreed that the Chinese currency is overvalued. So both of these markets, the government has intervened significantly, and they've let the market come down a bit. They've let the currency depreciate a little bit, but it's likely not yet at that market clearing price, back to economics. So I think those are the stories to continue watching. But I think the more important punchline is to understand that the direct impact of China on the portfolio is going to be relatively muted in that 2 to 3% range. That said, equity markets are somewhat correlated, and We're in a global economy. So whatever's impacting the Chinese economy that will impact all other economies and all other markets, that's fair game to talk about. And that's again, a little bit hard to put your finger on and predict, but say lower global growth or volatility in the currency markets and that sort of thing could still contribute to continued poor performance.
So if we're keeping an eye on China, we're keeping an eye on oil, the health of the U.S. economy still seems pretty good right now.
Right.
I think a common worry amongst investors is, based on the volatility, maybe not the underlying reasons for the volatility, this starts to feel like a 2008 again. And it's not that, right? I mean, what are the major differences between what we're seeing right now versus people's big fear that we're entering another 2008? Right.
Well, we've seen quite an impressive bull market since the low was turned in 2009. And again, equity markets are risky, so we might just be seeing the normal volatility and occasional drawdown in equity markets.
Right.
I agree with you, and I'd like to reiterate that this is not 2008. In 2008, that was very much a financial-led crisis where a lot of investment banks were taking unwarranted levels of risk, had a lot of leverage, there wasn't transparency, and you had, combined with that, really a large portion of the mortgage-backed securities market kind of unravel. Like, a lot of people thought they weren't taking risk, they were taking risk. There was a lot more correlation in returns than we realized, and that was combined with a very weak economy. So we were kind of at the precipice of a recession.
Yeah.
Coincident with this financial market meltdown. So that is not the case now. We, as you said, we have a much stronger economy than we did then. Now, it could be slowing, and that could, eventually find its way into corporate profits and level of the market. But this I would chalk up to something much more regular in equity investing than 2008 was.
Yeah, there's that old joke that equity markets have predicted 9 of the last 5 recessions,
Right.
and it seems to be like one of those moments right now. So, not understanding really how people's behavior can impact markets. I mean, is this one of those things where, and I don't know if they've happened in the past, where a panic moment actually can lead an economy into recession? Because it seems like with the fundamentals here in the U.S., everything is pretty good.
Right.
But there's still that level of panic, warranted or unwarranted. What do we think of that and kind of behavioral finance's impact on?
It's tough to say. I think the U.S. economy is so dependent on consumption,
right.
Private consumption. So I don't believe consumption has recently really drawn back in any significant manner. I know consumer credit has expanded, so people are finding the financing deals and taking on credit card debt and consuming more. I think the bigger risk in behavioral finance is, say, based on headlines or perceptions or someone's overconfidence they can predict something, making a decision in the portfolio, which someone can regret. So selling out of the market unnecessarily when an investor has a very long horizon, and then thinking you're going to avoid a drawdown and thinking you're going to be able to correctly time the recovery and get back in. I think that's the much bigger risk when we talk about behavioral finance than really kind of a direct translation on the aggregate economy.
That makes a lot of sense. So I appreciate all the insight into how Symmetry is viewing what's going on and its look back at 2016. I think right now, most people have the big question is like, what should I do right now? And there's a couple of things to remember, really. These things, I think, are mostly short-term events. Even if you're entering the retirement phase of your life, you might have 10, 20, 30 years, which are fairly long time horizons. And these things being short-term, you will likely see multiple periods of volatility, maybe in a bear market or recession or two over the course of the next 20, 30 years of your life. It's important to remember, too, that, as we talked about earlier, most investors in a Symmetry portfolio and an Apella account have an exposure to fixed income, so they're not really exposed to the full craziness that's going on just in equity markets.
Right.
So with that said, we want to make sure that investors are actually taking the time to remember they hold a portion of fixed income. You're not in all stocks for the most part. And on top of that, really, and I think you see this with advisors that Symmetry works with, we're very careful that we want to put every one of our investors in a portfolio or an asset allocation which matches their risk appetite, their long-term goals, something that they can sustain and be in for quite a long time. And we believe that our clients are very well positioned to ride out short-term periods of volatility like this based on that process and that planning process. And changes to, and I think everybody from research would agree with this, if you're going to make changes to your portfolio, it shouldn't be based on what happened yesterday or what we think is going to happen tomorrow. It should really be based on a financial planning reason.
Absolutely. Yeah.
So, once again, if you have questions about anything that we've talked about here today, questions about your own portfolio, questions about your personal circumstances, or just want clarification on any financial planning topic, feel free to reach out to me and our team at any time. We're happy to answer your questions. Hope you enjoyed the video. And once again, Phil, thanks a lot for your time today.
Thanks for having me.